Hello, everyone. Welcome back to Muffet Investment Views. Today, we're tackling a crucial topic that could save you loads of money: how to beat the taxman. We'll delve into all the tax breaks available in the UK, aiming to help you preserve and enhance your hard-earned money. Remember, the more you protect your money from the taxman, the richer you become. Why is it important? Let's talk about why understanding compound interest is key for your financial growth. Albert Einstein once proclaimed compound interest as the eighth wonder of the world. Even a modest annual savings of 2% from tax-efficient strategies can accumulate significant gains over time. Let me give you an example. Imagine someone saves £300 a month with an annual growth rate of 5%. Without tax, this person would amass £434,879 over 40 years. However, if taxes reduce this growth rate to 3%, the savings only reach £271,444. This vast difference underscores the importance of utilizing every available tax allowance to protect and grow your wealth long-term. By leveraging tax-efficient savings options, you can substantially enhance your financial future. Personal allowance. First up, let's discuss your personal allowance. Here in the UK, everyone is granted a tax-free personal allowance, which is currently £12,570 for this tax year. This means you don't pay any income tax on the first £12,570 you earn annually. It's crucial to be aware of this allowance and make sure you fully utilize it. Marriage allowance. Moving on, we have the marriage allowance. If you're married or in a civil partnership, you might transfer up to 10% of your personal allowance to your partner, provided they earn more than you. This could save you up to £252 a year. Every little bit contributes significantly. Individual savings accounts, ISAs. Next, let's explore individual savings accounts, or ISAs, which are a cornerstone of tax-efficient saving in the UK. The beauty of ISAs is that any interest, dividends, or capital gains accrued within these accounts are completely free from UK tax. Types of ISAs. ISAs come in various forms, each tailored to different saving and investment needs. Cash ISA. This is akin to a regular savings account, but with one major perk: the interest you earn is completely tax-free. Best for. Ideal for those seeking a low-risk and easily accessible option. Features. Offers either fixed or variable interest rates, and while funds are usually readily accessible, some accounts might impose withdrawal restrictions or penalties. Stocks and shares ISA. This ISA lets you invest in a variety of assets including stocks, bonds, mutual funds, and ETFs, with the advantage of tax-free dividends, interest, or capital gains. Best for. Suitable for investors looking for potentially higher returns who are comfortable with associated risks. Features. Be mindful that the value of investments can fluctuate and various management fees and charges may apply based on the provider. Innovative Finance ISA. This account type allows you to invest in peer-to-peer lending and crowdfunding debt securities, essentially lending your money to borrowers or small businesses. Best for those aiming for higher returns who are willing to accept more risk, as these investments are not covered by the Financial Services Compensation Scheme, FSCS. Features. Offers potentially higher returns than cash ISAs, but with increased risk. Lifetime ISA. Designed to aid in saving for a first home or retirement, the LISA allows individuals to contribute up to £4,000 annually, with a 25% government bonus on these contributions. Best for first-time homebuyers or those focusing on retirement savings. Features. The government boosts your contributions by 25%, up to £1,000 per year. Be aware of penalties for withdrawals not related to home purchasing or before age 60. Junior ISA. A junior ISA permits parents or guardians to save or invest on behalf of their child in a tax-efficient manner. Best for parents or guardians interested in building a financial foundation for their child's future. Features. Available in cash or stocks and shares options, with an annual limit of £9,000, and funds are locked until the child turns 18. Annual allowance. For the 2023/24 tax year, you can invest a total of £20,000 across all types of ISAs without exceeding this cap. Transfer options. You have the flexibility to transfer your ISA from one provider to another or between different types of ISAs, such as from a cash ISA to a stocks and shares ISA. Transfer rules. It's critical to follow the proper transfer procedures to maintain the tax-free status of your funds. Accessibility and withdrawals. Cash ISA generally allows for immediate access to funds, although some accounts might have notice periods or penalties for early withdrawal. Stocks and shares ISA. Withdrawals may take a few days as the underlying investments need to be sold. Innovative finance ISA. Withdrawal availability may depend on finding a buyer for your loan parts. Lifetime ISA. Withdrawing funds before age 60, unless it's for purchasing your first home, typically incurs a 25% penalty. Junior ISA. Funds remain locked until the child reaches 18 years of age. Considerations and risks. Stocks and shares ISAs and innovative finance ISAs come with investment risks. The value of your investments can go up and down. Fees and charges. Keep an eye on management fees, transaction costs, and other potential charges, especially pertinent for stocks and shares ISAs and innovative finance ISAs. Choosing an ISA. Pinpoint your savings or investment goals, whether they're short-term savings, long-term investments, buying a home, or saving for retirement. Risk tolerance. Evaluate your risk appetite. Opt for a cash ISA if you prefer low risk or venture into stocks, and shares ISAs for potentially higher returns. Provider comparison. It's beneficial to compare different ISA providers based on interest rates, fees, and investment options to find the best fit for your financial needs. ISAs present a flexible and tax-efficient way to save or invest. By fully understanding the various types and their advantages, you can select the ISA that best matches your financial objectives and risk tolerance. It's always wise to consult a financial advisor to maximize the benefits of ISAs. Pension contributions. Another critical aspect of tax-efficient saving involves pension contributions, which the UK government significantly incentivizes to encourage retirement planning. For a full review on self-invested personal pensions, please watch our video on this at Muffet Investment Views. How pension tax relief works. When you contribute to a pension, you receive tax relief from the government, effectively increasing the amount deposited into your pension pot. The level of tax relief you receive is linked to your income tax rate and the specific pension scheme. Basic rate taxpayers. For every £80 you invest, the government contributes an additional £20, thus your total contribution amounts to £100. This reflects the government reimbursing the basic rate of tax at 20%. Higher rate taxpayers. Beyond the basic rate relief, you can claim additional relief through your self-assessment tax return. Hence, on a £100 contribution, after the initial £80 contribution and the government's £20 addition, you can reclaim another £20, effectively reducing your net cost to £60. Workplace pensions. Net pay arrangement. Contributions are deducted from your salary before any tax is applied, meaning you immediately receive full tax relief at your highest marginal rate, 20%, 40%, or 45%. Annual allowance. Annual limit. The maximum you can contribute to your pension annually while still receiving tax relief is the lesser of £40,000, or 100% of your earnings. Carry forward. If you haven't utilized your full annual allowance in the past 3 years, you have the option to carry it forward to the current tax year, assuming you were a member of a pension scheme during those years. Lifetime allowance. Limit. There's a cap on the total amount you can accrue in your pension pots without facing additional tax charges, known as the lifetime allowance. For the 2023/24 tax year, this limit is set at £1,073,100. Charges. Should your total pension savings exceed this limit, any excess is subject to a tax charge, which is 25% if taken as income or 55% if taken as a lump sum. Capital gains tax allowance. Let's shift gears to capital gains tax, CGT. CGT is levied on the profit from selling an asset that has appreciated in value, such as property or shares. Fortunately, there's an annual CGT allowance, which for the current year is £12,300. By effectively using this allowance each year, you can significantly minimize your tax liability. Dividend allowance. Additionally, if you receive dividends from shares, you benefit from the dividend allowance. For the current tax year, the first £2,000 of your dividend income is completely tax-free. After this threshold, dividends are taxed at varying rates depending on your overall income tax band. It's crucial to be aware of how this impacts your tax commitments. Tax relief on property investments. For those of you invested in property, there's important information regarding tax relief on mortgage interest payments. While direct tax relief for landlords has been phased out and replaced with a 20% tax credit, this still represents a valuable means to reduce your tax bill. Moreover, forming a limited company to manage your property holdings can offer even greater tax advantages. Operating your property investments through a limited company, often known as a limited company, can lead to multiple tax benefits. Here's a breakdown of how this can work in your favor. Corporation tax. Lower tax rate. Typically, companies are subjected to corporation tax on their profits, which, at 19%, is generally lower than the personal income tax rates. Salary and dividends. As a director of your limited company, you have the flexibility to take a mix of salary and dividends. While salaries are taxed along with national insurance contributions, dividends attract a lower tax rate and aren't subject to national insurance. This arrangement often proves more tax efficient than receiving all your income through salary. Dividend tax rates. Basic rate, 8.75%. Higher rate, 33.75%. Additional rate, 39.35%. Expense deductions. A broad spectrum of expenses can be claimed against your company's income, effectively reducing the taxable profit. This can include travel, equipment purchases, office supplies, and even a portion of your home utilities if your home serves as your workspace. Pension contributions. Tax relief. Any pension contributions made by your company are considered deductible business expenses, which decrease the taxable profit. Moreover, these contributions are exempt from national insurance, adding another layer of tax efficiency. National insurance contributions. Opting to receive your income through a mix of salary and dividends can lead to reduced national insurance contributions. Unlike salaries, dividends are not subject to NICs, which can lead to significant savings, especially when compared to drawing all your income as a salary. Retained profits. You have the option to retain profits within the company rather than distributing them entirely as salary or dividends. This strategy allows for deferral of personal tax liabilities, providing your company with opportunities to reinvest in growth or save for future financial needs. Entrepreneurs relief. Also known now as business asset disposal relief, this relief reduces the capital gains tax on the sale of your company. Currently, the rate stands at 10% on qualifying gains, offering a significant tax reduction. VAT benefits. If your company is registered for VAT, you can reclaim VAT on business expenses, which reduces your overall cost. Tax-free allowances. Your company can offer various tax-free benefits, such as providing mobile phones and covering business travel expenses, further reducing your overall tax burden. Inheritance tax. Transferring shares of a property company can be more straightforward than transferring individual properties, enhancing inheritance tax planning. Pension contributions. Profits from the company can also be used to fund tax-deductible pension contributions for directors, providing a tax-efficient method for retirement saving. Limited liability. Risk management. Operating through a limited company provides limited liability protection, which safeguards your personal assets in the event of financial difficulties faced by the company. Example scenario. Consider Jane, who established Jane's Property Investments Limited to manage her buy-to-let properties. Here's how being incorporated benefits her financially. Jane pays 19% corporation tax on rental profits instead of personal income tax rates, which could be as high as 45%. She can fully deduct mortgage interest from her taxable profits, reducing her overall tax liability. By retaining profits within her company, Jane defers personal tax, allowing her to reinvest in more properties or save for future endeavors. She draws a portion of her profits as dividends, benefiting from lower dividend tax rates. Charitable donations. Not only is giving to charity a noble act, but it also offers tax advantages. Through gift aid, charities can claim an extra 25p for every £1 you donate, and if you're a higher rate taxpayer, you can claim the difference between the basic rate and your highest tax rate on the donation. It's important to maintain records of your donations to ensure you claim these tax reliefs. Inheritance tax reliefs. Inheritance tax, IHT, can significantly impact your estate, but thankfully, there are reliefs available. For instance, the annual exemption permits you to gift up to £3,000 each year without it counting towards the value of your estate for IHT purposes. Additionally, there are extra exemptions for gifts made during a marriage or civil partnership and regular gifts from your surplus income. Venture capital trusts. Lastly, let's discuss venture capital trusts, VCTs, which are designed to encourage investments into smaller, higher-risk companies in the UK. VCTs come with several appealing tax reliefs. Up to 30% income tax relief. You can receive up to 30% upfront income tax relief on investments up to £200,000 per tax year in newly issued VCT shares. For example, a £10,000 investment could reduce your income tax bill by £3,000. To be eligible for this relief, you must have paid or owe at least that amount in income tax for the year. Additionally, the shares must be retained for at least 5 years to keep the relief. Tax-free dividends. Any dividends paid on qualifying VCT shares are exempt from income tax, providing a source of tax-free income. This is particularly beneficial given the recent reductions in the dividend allowance. Tax-free growth. Any capital gains realized upon selling your VCT shares are exempt from capital gains tax, allowing for tax-free growth. Note, however, that capital losses on VCT shares cannot be claimed for tax purposes. And that wraps up our deep dive into how to beat the taxman. By taking full advantage of these tax breaks, you can significantly reduce your tax bill and retain more of your earnings. If this video has been helpful, please give it a thumbs up, subscribe for more financial tips, and hit the notification bell so you don't miss any updates. Thank you for watching.